Right, let's bring you the very latest in the world of business, starting off with the JSE is weaker, along with most global markets, as investors digested a decision by the U.S. Federal Reserve to hold interest rates steady as expected. Now, the Fed did signal that a March cut was unlikely. For analysis of the latest market news, we're joined now by Grant Nader, Benguela Global Fund Manager's Senior Portfolio Manager. Very good afternoon to you, Grant. Thank you for your time. Perhaps let's start off with an overview of how the markets are faring so far today and what's driving them.
Sure. So we obviously saw quite a steep sell-off last night in the US. We saw some of their some of their biggest companies, Microsoft, Google, and the like, came out with what actually were good numbers, but relative to what was in the price and what was expected, weren't as well received. So they saw a sharp sell-off there. Of course, that market has rallied 20% in the past 3 months. On the other hand, we're probably up 4 or 5% in the last 3 months. So we continue to give back some of the gains. We're following that overnight loss over into our market, down 0.7, 0.8% on the day. And we're actually seeing pretty broad-based weakness. Only 1 or 2 bright spots, one being multi-choice, which is now subject to a takeover bid, and a handful of other stocks. For the most part, the market is in the red. So there's a little bit of nervousness around. There's a lot of news flow around. The Fed came out last night with, I wouldn't say disappointing, but that pushed out some of the rate expectations that people had. Probably were over-optimistic in those expectations to begin with, but they pushed those further out. We also saw Eurozone inflation that's come out, and that wasn't quite as soft as they'd been hoping. That economy is basically stagnating completely at this point. So there's a real risk of stagflation there. So there's a lot of news flow and there's not a lot of conviction in what's happening in the market. We're up one day, down the next. And I think we need some sort of digestion of where we are. And there's a lot of value in the market, but perhaps how do we unlock this value is the question we're all asking.
Yeah, absolutely. On the other end, Grant, the Absa Purchasing Managers Index declined to 43.6 index points in January of this year. That's down from 50.9 in December. Talk us through what's driving these declines.
That was quite disappointing, I must say. We had a decent number in December. As you said, now it's worth remembering this is a survey, and they ask purchasing managers whether they think things will be better or worse next month than the month before. So it's not a prediction. I mean, it is a predictive index. It's not cast in stone. And what it indicates is their outlook is actually quite bleak. Orders, new orders came in significantly lower in terms of the expectations. Inventories are significantly lower. Demand is lower. And one has to ask the question, how much is Transnet perhaps playing a role when it comes to inventories and new orders? Exports remain below the 50 level, 50 being contraction and above 50 expansion. We haven't seen the index this low very often, only a handful of times, going back all the way back to 2007, 2008. So I think there's a little bit of an anomaly here. There's a few moving parts. Things have been easing. We've seen load shedding improving. We see some rate cuts in the cards. So I think this is a short-term blip, perhaps some nervousness ahead of elections and some of the, as I said, the Transnet hangover. If they look out 6 months, they did a similar survey 6 months out, and most respondents expect the environment to be a lot better than it is now. So it's not a good number, but I don't think this is necessarily the start of a new trend.
Now, Glencore is cutting its production target for Cobalt this year. Help us make sense of that full year 2023 production report.
So the production report was slightly lower, I think about 6% lower than the year before. And of course, the production outlook is another cut. I think this is where the market's paying attention. They're cutting their forecast for this coming year significantly relative to the targets they'd set in December 2022. And of course, Glencore is a very proactive management team. The cobalt price has fallen, I think it's close to 50% from its highs back in 2022. And in response, they're pulling back on production. They have held back already. Last year, they were stockpiling, hoping prices would recover, and they didn't. So rather than increase production and put further pressure on prices, they have the ability and willingness as a management team to pull back on some of that production. In contrast, there are other companies like CMOC Group from China that's actually ramping up production. Indonesia has been ramping up production and supply. So there's a lot of supply coming onto the market at a time when prices are falling. They're not helping themselves here. And really what will benefit the industry is a little bit of supply management, and that's where Glencore comes in. They are very good at that. They were the biggest producer in the world. They've just, I believe they've been pipped by the CMOC group, who are now outproducing them. But Glencore's been through a number of cycles. It's telling you that they're in a tough cycle, but potentially looking out for cycle lows on the horizon as EV demand maybe picks up again. There's been a saturation of EVs in the market. Demand has slowed there. Consumer goods have slowed, and that hasn't helped the price outlook for cobalt and copper. So we'll see. I think they're doing the right thing. Even if the initial reaction perhaps won't be positive, long term it's the right trade.